we are going to use net asset valuation and the dividend valuation method. These calculations can be easy, but you miss out one thing, and everything becomes what? Becomes very wrong. Okay? Okay, so we are told that BIL was incorporated in 2017 as an events management company. At their recent AGM for the year ended 31st December 2020, shareholders resolved to expand its business through acquisitions. Okay, the company has identified a potential target, that is QHL, a wholesale general merchandise company limited. Okay, sorry, company located in its vicinity. Okay, it is anticipated that QHL will fit. Okay, the sector in which QHL operates has shareholders' cost of equity. You have cost of equity, that is KE, direct. You have cost of equity. Then you have also a risk premium of 3%. Okay. The dividend per share paid during the year is 2,000, which is expected to grow at a rate of 4% per annum. You need to know where you are going to use this information. You're going to use this information as you answer part Roman 2. Dividend, as you use dividend valuation method, you will need to use this information. Okay, we have balance sheet. We have a balance sheet. Okay. Why are you given this balance sheet? Of course, here it's balance sheet of the company you're going to acquire. So you will use this balance sheet to get your total assets and as well to get total liabilities, so that you can be in a position to get net asset. Okay. An analysis of QHL's receivables register indicates that 2% of trade receivables have been uncollected for over 3 years. So we are going to do some adjustments. As you get your net asset, you will need to do some adjustments, especially if you have information on the required in additional information. Like now you will need to adjust QHL's receivables. They indicate that 2% of trade receivables have been uncollected for over 3 years, and the board has resolved to write them off as bad debts. So it means that you will need to remove the 2% of trade receivables. Evaluation that was carried out by an independent valuer established that patents are marketable at a full value. Okay, what does that one mean? It means that in our balance sheet, we have patents. We have patents. And now, as long as you find that you can actually know the market, you can tell the market value. You can tell the market value. Then, as you do your computation for net asset, you will need to take into consideration that figure. It will be part of your total assets. But in a scenario where you cannot tell the market value, then you exclude that patent part or issues related to goodwill, like that. Okay. Okay, they are telling us as well that while PPE, that is property, plant and equipment, is impaired and has to be written down by shillings 25 million by. So this is a reduction. Your PPE is going to reduce by 25 million. So you will need to identify your PPE. You have PPE here. Then you reduce the value by 25 million as you're trying to get total assets. Okay. In addition, 5% of inventory is obsolete, owing to changes in technology. What does that one mean? It means that as well you're going to adjust your inventory. You reduce your inventory by what? By 5%. percent. Part A Roman 1. That is using net asset method or technique. Remember here you're writing a report here. I'm not going to go into those details, but of course you need to start with what? With the report format. To, from, date, subject, then give us a bit of introduction, start answering. You leave like a space, do the workings, do the appendix, then you give the conclusion. But here we are going to just answer direct. Now, how do you use the net asset method or technique? As you're using net asset, you are trying to get the total value of the company, the total equity. Actually, it's the total equity of the company you're trying to acquire. And how do you get this total equity? Using net asset method. You get the total assets, then you subtract the total, you subtract total liabilities. That's how you get your net asset. That's how you get your net asset. You get all your assets, then you remove the total liabilities. Okay, so you can again draft that balance sheet the way it is given, but for you, you focus on assets and liabilities. But as you focus on liabilities, there are some things you need to take into consideration. For example, here you have non-current liabilities and current liabilities. Of course, you're looking at all liabilities here. You are looking at all liabilities. Okay. So, but here there is a component that you will not include. Anyway, let me be systematic without leaving anything. Let's put land. I don't want to confuse you. We are trying to get the total assets. I'm going to put, you'll be telling me the figures. Land and building. Do we have any adjustment in additional information? Here we are trying to get the assets, the total assets. Do you have any adjustment in additional information? We don't have. Okay, we don't have. So you pick the figure the way it is. You pick the figure the way it is. This is shillings in 1,000. Okay. Then what else do we have next? Kindly tell me so that I don't waste time going back to. Next is what? Property, plant, and equipment. Okay, that is PPE. Do you have any adjustment there down? Property, plant, and equipment. When you look at, you have property, plant, and equipment, this one. But in additional information, they told us that somewhere that PPE is impaired and has to be written down by what? By 25 million. So to get the new PPE, you will get this figure. Then you remove 25 million. Okay. What do you get? We get this figure. We get this figure and remove 25 million. So you will just remove 25,000 because you're keeping 3 zeros. So I remove 25,000. How much do you get?
1055.
Minus 25,000. That's what you have?
Oh, yeah.
All right. Next, what else do we have? Next is motor vehicles. Do you
motor
have any
vehicle.
adjustment? No. So you just pick motor vehicles, motor vehicles, motor vehicles. Then you have patents. How much is this?
The motor vehicle is 65,000.
Pardon?
The motor vehicle is 750.
750,000. Then here,
Yes, 55,000.
55,000. Do we have any other? We are done with
No.
we are done with current assets. Next, next, you can look at what? You can look at your current assets now. You can look at your current assets. Oh, if you want, you first get the what? The total. But in an exam time, in an exam time, all you need is what? Total assets. You can just combine. So next you can maybe here, since it's a discussion, I can just put here what? Current assets. Then I look at next is what? Is it inventory? Inventory. But we have some adjustment from additional information. Inventory is 560, but they told us that in addition, 5% of inventory is obsolete, owing to changes in technology. What does this one mean? You reduce this value. You reduce this value by 5%. So the easy way or shortcut, you simply get 95% times this. That is the shortcut. That is the shortcut. So you can get 560, 1,000, then you multiply by 95%. Or if you don't want to use that approach, you get 560,000, then you remove the 5% of 560. You get the same. You get the same. Here, how much do you get? 0.95 times 560.
Maximum cost of capital.
Then
Security.
next is what? Next, we have trade receivables. Do we have any adjustment? Do we need to make adjustment? They told us that 2% of trade receivables have been uncollected for over 3 years, and the board has resolved to write them off as bad debts. Remember, if you provide for bad debts or if you write off, you are going to reduce the current or the book value trade receivables. So we are going to adjust this figure by 2%. Is a shortcut. Simply get 98% times this. 98% times 50,000. Okay, this is trade receivables, and we are going to get 98% times what? Times 50, times 50,000. How much do you get?
49.
Next, colleagues. Next is what? We have
Short-term investments.
Short-term investments. Do we need to make any adjustment? No, we don't have anything affecting that, so we can put it here. How much is that? 100.
100,000.
Then next is what?
Repayments.
Prepayments, then cash. All those ones, no adjustment. Payments, these are prepayments. Then next is cash. Prepayments, it's how much?
Payments is 15,000.
15,000. Then cash?
Cash is 200,000.
200,000. Do we have any other assets? You don't have any other asset, you simply add. Add from here up to this. So that is my total asset. That is my total asset. So I will need the this is my total assets. So what else you need to look at now? The liabilities. You need to look at the liabilities now. You look at liabilities. Tell me liabilities. What do we have? Liabilities, we have we have the 6% bank loan, the 10% debenture, the 10% preference shares. Colleagues, preference shares are in the form of liabilities. In some questions, you'll find that preference shares are under equity. If you find that preference shares are under equity, as you try to get your total liabilities, don't forget to include as well preference shares. These shareholders expect a fixed dividend. It makes them to be what? It makes it to be an obligation to the side of the company. So let's just pick. Do we need to adjust anything? When you look at your liabilities, do you need to adjust anything? Simply add and give me the total. Simply add and give me the total. Exclude the proposed dividend. Don't include the proposed dividend. Just add other things and give me the total. Give me the total liabilities. Who can tell me the reason why we exclude the proposed dividends? You see the answer in the chat. You can see the answer in the chat.
Okay.
Why do we exclude the proposed dividend? But as you add, don't include the proposed dividend. Add other things, but exclude the proposed dividend. What is the total? What is the total?
I'm getting 1,154,000.
154,000.
1,154,000.
Like this, eh? Is it like this?
Yes.
Our colleagues, are we together? Or there is a question? Are you seeing my workbook or you are seeing the question paper?
Workbook.
Okay, so we get the total assets minus total liabilities. In an exam, try to go ahead and list all those things and add up. Because if you do this, maybe I don't know, but the examiner may give you some few marks, but I don't know. Okay, so this is our net. This is our net. This is our net. This is our net hat and our net asset. This is our net asset. Okay, so next part we are going to look at. Before we look at the next part, once you have your net asset, this is like your total, the total equity of the company you're trying to acquire. This is like the total equity of the company you're trying to acquire. But if you want to know, the price per share based on these values, based on this net asset, then you will go ahead and get here the value or the price per share, the value per share. You will get your net asset, then divide by number of shares. If you want to know the price per share, because most times when you want to advise when you want to advise, it becomes hard to advise basing on this. Anyway, if you want to advise basing on this, then you will need to look at the total equity in the balance sheet. But if you want to advise basing on the price per share, then you have to do this working. The net asset divided by number of shares and see what is the figure now. You get this figure divided by how many shares? Do we have the number of shares? Let me see. Okay, we don't have.
Per value is 10,000.
Yes, but you can simply get this divided by this. You get what? How many shares? Remember, this is in a million.
240,000 shares.
You get what? 240?
240,000 shares.
So you divide by 240. So what you get here, let me just remove 240. This is what you have in your book. When you use your calculator, this is what you get. When you get this figure divided by number of shares, this is what you get. This is per share. This is per share. So what does this one mean? What does this one mean? If you're the one to acquire, this company, can you go ahead and acquire? Oh. What does this one mean? If you're to acquire this company, you acquire. Why?
Because the value is higher than 10,000, the nominal price per.
Yeah, true. So you look at the market price now, then you compare it with the par value and see whether indeed this company is in a good position. Okay, and here the par value is 10,000. Since the value per share now is higher than the par value, then here you can go ahead and actually acquire it. Okay, so we go to the next method, that is what dividend. Before we go to the next method, are we all okay with this? Are we okay with net asset method? Take note, preference shares, the figure you have must be included as you get total liabilities. The examiner may put preference shares under equity, but for you, you have to go ahead and do what? And include that preference shares as you get your total liability. So next is using dividend valuation method. And with dividend valuation method, what do you need? You recall that here we use Gordon's model from KE is equal to D1 over P naught, then plus G. But here, since as you do this, as you use the dividend valuation method, your aim is to get the market price of a share. That's the reason why you're trying to, that is the reason why you're using this method, to get the market price per share, that is P naught. And how do you get P naught? Direct. P naught is equal to D1, then everything divided by what? D1, everything divided by KE, that is cost of minus G. If you cannot recall this, then you say from KE, because in an exam you may forget this. You say and you find that you can recall the other thing. So you say from KE is equal to D1 over P naught, then plus G. So you'll be looking for this one. You'll be looking for this one. If you rearrange this formula, you get this one. If you rearrange, you get this. Okay. So are we given D1? D1 is dividend that is yet to be paid. D1 is
You are breaking.
can you hear me?
Yes.
Okay, D1 is D naught plus 1 plus D1 is equal to D naught times 1 plus G. That is if you are not given D1 in the question. Because in the question they can give you D naught. Okay, so we read through and see what are we given. What are we given? What are we given in the question? From here, we are given the cost of equity direct. That is 18%. So where there is KE, you directly put 18%. Does it make sense? Then you have a risk premium. But wait. You have shareholders cost of equity of 18% and a risk premium of 3%. The dividend per share paid during the year is 2,000, which is expected to grow at a rate of 4%. What does this one mean, colleagues? Are we given a D naught or D1? This one, is it D naught or D1?
D naught.
This is D naught, the one that has been paid, that is D naught. So you can use this D naught to get D1. You have G in the question, which is 4%. Are you given KE? Are you given KE? KE is what?
18%.
Cost of equity, it was given.
It was given 18%. Okay.
What about the premium?
Someone was asking me during the day, what about risk premium? Now, you are given a cost of equity. Cost of equity is what? Isn't it KE? Cost of equity is KE. Maybe if that 18% was what? Risk-free rate of return. If it was risk-free rate of return, then to get KE, it would be KE is equal to what? KE is equal to risk-free rate of return, then plus risk premium. Plus risk premium. That is if at all that 18% was risk premium. That's what you do to get what? To get KE. Where risk premium, remember, no. Times this is beta. This is beta, equity beta. That is equity beta. Equity beta times risk premium. That is in a scenario where you're not given cost of equity. That is to me, that's what I would do. But here you're given already this KE is cost of equity, which is already given as 18%. So that risk premium, I don't know. I don't know, but you don't need to use it. To my side, I can't use it. I could use this risk premium in a scenario. Our colleagues' risk premium, remember, is equal to what? Risk premium is equal to RM minus RF. That is risk premium. That's risk premium. But we are not going to use it anyway. Already you have cost of equity. Okay. Okay, so we substitute in our formula. Where there is a D note, we put what? 2,000, then times the we can say directly 1 point what? 1 point, what is our G? That is 4%. So that is 1.
4%.
I can just simply divide, I can simply multiply by 0.4. Then divide by what? KE is 18%, 0.18 minus 0.04. What do you get? What you're doing here, you are actually trying to convert. You are trying to convert D note to D1, because ideally D1 is equal to D note into 1 plus G. You get it? So whatever you're doing here, you're trying to convert D note to D1, whatever you're doing here. And D1
To
can
get a
be,
future dividend.
yes, to get the future dividend. D1 can as well as be equal to D note in a scenario where there is no growth, where there is no growth in a dividend. In a scenario where there is no growth in a dividend, D1 is equal to D note, because here this G will be equal to 0. 1 plus 0, you get 1. 1 times D note, you get D note. So depending on the question you're handling, D1 can be equal to D note. In a scenario, that is only in a scenario where there is no growth in a dividend. But if you have growth in a dividend, then it means that the future dividend is going to increase by that growth in dividend. Okay. So basically, in this computation, we look at the future growth dividend. We look at the future dividend, not the dividend that has just been paid. We look at the future dividend, the dividend to be paid. That is our focus. What do you get here? What do you get?
I got 14,857.
Pardon? Shillings what?
14,857.
14,857. This is per share. This is per share. This is per share. This is what you get, all of you.
Yes.
Okay, colleagues. So, which conclusion can you put? Should do, because at the end of your computation, you can conclude. Should BIL go ahead and acquire the QHL or not? You see all the methods, method 1 and method 2. You are getting value per share which is higher than the par value. So it means that this company you're trying to acquire can be more profitable. So you can say BIL should go ahead or should proceed and buy or acquire QHL, since under both approaches, its market price per share exceeds the share per value of shillings 10,000. Okay, you can go ahead and acquire the other company. Okay, so that's all. You will use the same knowledge to answer December. Let me just you will use the same knowledge, because I wanted we do a separate rather another question that really requires some. You will use the same knowledge to do December 2021. This why I've opened the word. You use the same knowledge to do December 2021. Which screen are you seeing? December 2021. Let me just try to open and. Which screen are you seeing?
Workbook.
All right. December. I'll give this topic some good time. You never know. December 2021. December 2021. Yeah. You will use the same knowledge. This is December 2021. Question 4. You have everything here. You have profit after tax here. I hope yesterday we discussed, I recall we discussed this, isn't it? So you will use the same knowledge. You are given, in this question, you are given the price earnings ratio, which really makes your work easy. So you can actually, when you look at this, what I have highlighted can help you to answer Roman 2. Can help you to answer Roman 2. Because with Roman 2, you're looking for market price per share. So from PE ratio, which is equal to what? The market price per share over the earnings per share. I believe you can answer that question from this, from PE ratio. PE ratio. No, we have some people here who didn't follow. PE ratio is equal to what? I told you that P stands for the market price per share. Then over E stands for earnings per share. So in the question, you are given PE ratio, and you can actually get EPS. So your market price per share, the one you're looking for, will be equal to earning price per PE ratio. Then you multiply by earnings per share. Where your earnings per share, will be equal to what? The profit after tax divided by number of shares. You have the profit after tax in the question, and you have the number of shares. Remember, whatever you're doing, you are in the books of the company you're trying to acquire. You are trying to get the EPS of the company you're trying to acquire. So I believe here you can score those 4 marks. The number of shares, obviously you know the number of shares from here to get this figure. But as you pick this figure, don't always forget these 3 zeros. That is how you get your market price per share using That's how you get the market price per share using the using the PE ratio. Then using net asset method or technique, you will read through here. You read through your information. This is balance sheet. And you're given additional information. You actually see that it is the same. Like the number we have handled. That is the same. We were handling which year? We were handling which year? That was June 2022. June 2022, it was really the same, almost the same. You have the 4%, they changed the percentages. The board resolved to write them off. So here they are telling you that goodwill doesn't have a ready market. If goodwill doesn't have a ready market, then as you get your total assets, don't include goodwill. Don't include goodwill because it doesn't have the market value. But if it has the market value, then you include the goodwill. Other things are the same. Proposed dividend, don't include it as you get the total liabilities. The role of corporate restructuring in corporate finance. Here you can read through the techniques of addressing risks in investment appraisal. Colleagues, try to read the theory. Try to read the theory. We tend to focus more on calculations, but people who have passed this paper have continuously told me the theory. It's the theory that saved them. So let's try to give the reason why calculations are not all that good is that the percentage of failing a calculation number is high. It's high. Just misfire. One small statement and everything is wrong. But someone who knows theory, you look at this 15 marks. Okay. Colleagues, try to read the theory about mergers and acquisition. Try to read the theory about mergers and acquisition, plus those efficiency things, the hypothesis things, those efficient, also the yield curve, those things. Try. Okay, I have a question that I wanted to discuss. Master, let me hope you're trying to practice these numbers, these ones in this form. Let me hope you're giving them time. Okay, March 2021 question 4. There is something that I wanted to highlight on, especially as you get your PE. As you get your PE. As your PE is equal to market price per share over EPS. Now, somewhere they told us that, we discussed this yesterday. We discussed this yesterday. In a scenario where you see that you're given some, which question was this? They will give you something like proxy of proxy. There was a number, but I'm failing to trace it. Proxy of. They can give you some figure like you are dealing with a company that is not listed. Then they give you a certain figure like 2 out of 3. 2 out of 3. They tell you that you are in the same company, but the proxy of the other company that is listed is 2 out of 3. Now, when you're given that, as you get your PE ratio, of the company that is not listed, you get the PE ratio, then times the proxy of the what? Of the company that is listed. It can be 2 out of 3. It can be depending on what you're given. So when you meet that kind of statement, don't be confused. Don't be confused. Okay. I believe we have tackled all the methods. See, from yesterday we are handling the business valuation. I believe we have tackled all the methods that we talked about. Remember, yesterday started with all this. We talked about PE. This was missing. Net asset method. We talked about PE. Today we have looked at dividend valuation. We looked at free cash flow. That is free cash flow to the firm and free cash flow to equity. We looked at the earnings yield. Okay.